Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. And today I'm joined by my colleague and my friend Mackenzie. Being that it's tax season in Canada, we wanted to do really a deep dive into taxes and ETFs and go through a lot of the frequently asked questions that we get on the team here at BMO ETFs. Just a reminder, today we're not providing any advice, tax advice, or investment recommendations. Today's show is all about providing you with education around investing and around using ETFs. Another reminder to please check out our YouTube channel and subscribe if you haven't already. If you ring the bell, you'll get notified every Friday as we go live. So hopefully you can subscribe this week. All right, Mackenzie, happy to have you with me today. Mackenzie is the director of BMO ETF Product Management, and we have worked together for over a decade now. Not to age us there, but she's a wealth of knowledge really around all things ETFs when it comes to the structure, the inner workings, and of course, taxes. So thanks for being here today, Mackenzie.
Great. Thanks for having me, Erin.
So for our 1-minute update before we get into taxes, I wanted to look at February flows. If you've joined us before, you will recognize these charts. They're from National Bank's ETF Research and Strategy Report. And each month we like to share insights in terms of flows. I think it gives investors an understanding of what the overall market is doing, where money's going. Not that you should be doing what everyone else is doing. Everybody's situation is unique, but it gives some insights into the overall market. So for Canada, for the month of January, we saw outflows, but in February, we were back to positive inflows with $4 billion. Equity ETFs had almost $1 billion in flows. We saw most of that going into Canadian and international equities. And within that, we saw a lot of flows going into dividends, financials, and healthcare. So that tells me that investors are still remaining very defensive in their positioning. The other thing I wanted to point out here is that the trend continues with the cash-like or HISA ETFs. Continuing to attract a lot of attention. Another $1 billion in flows for last month. You see that reflected in the fixed income chart at the top left. And on that note, I did want to draw your attention to a recent article this week in the Globe and Mail by Claire O'Hare, where she actually reported on the fact that OFSI, which is the Office of the Superintendent of Financial Institutions, basically they regulate banks. OFSI launched a full review in the fall and is studying HISA ETFs and any liquidity concerns that might be posed by these ETFs. So the jury's still out, nothing's been determined yet, but if OFSI or OSFI does take issue with cash ETFs or HISA ETFs, what could that mean for you? It could mean that they might lower the interest rates that clients are earning on these. So just something to be aware of, that there is some review going on in terms of liquidity in those ETFs. All right, Mackenzie, let's get into taxes. As we know, understanding about how your investments are impacted by taxes is really a crucial part to your plan and reaching your investment goals. And generally, there are two things to consider when it comes to taxes on your ETFs. The first is, of course, the taxes associated with selling your ETF, which I think is the better understood side of things. We know that if we sell an ETF for more than we bought it, we have to pay taxes. But the other side is the considerations related to the distributions received from the ETF as you hold it. And then within that, for international ETFs, there are also considerations about withholding tax, which we'll get into today. So today we are going to focus on that second part, that second aspect, ETF distributions, as that's generally where we get all of our questions from investors. So a couple things to clarify before we do get started on that. Number one, investors who hold ETFs in tax sheltered accounts, of course, RESPs, RSPs, RIFs will not be taxed on distributions and will not receive that T3 tax slip. If you hold your ETF in a taxable account, the tax man will find you and you will receive a tax slip, a T3 every year. You'll also be able to find information on the tax treatment of your ETF's distribution on all of the ETF providers' websites. So I've included a screenshot here of ours. These get posted typically at the end of February. And then the last thing I just want to note is that distributions can come both in the form of cash payments, or they can come in the form of a reinvested capital gain distribution, which is often referred to as a phantom distribution. And the way an investor deals with these two types of distributions is a little bit different, so we'll get into the differences a little bit today as well. All right, Mackenzie, hoping you can walk us through this slide and the different types of ETF distributions and the tax treatment of each of those.
Sure, and thanks again, Erin, for having me, and it's good to be back on Market Insights. So as Erin mentioned before, investors who receive distributions in a taxable account throughout the calendar year will receive information on the tax treatment of those distributions generally towards the end of February of the following calendar year. And if it's in a registered account, then thankfully you don't have to worry because you won't be getting a T3. But 'tis the season of taxes, I want to say, because a lot of those, the treatment of those distributions have been released, and now we're seeing a lot of dealers starting to post them into statements and things like that. So 'tis the season for taxes, so very topical right now, and hopefully we can dive through some of the things that may come up. So when you're looking at the different types of distributions, there's Canadian dividends, which I think we hear a lot about, which are dividend distributions that occur when an ETF invests in Canadian equity securities that pay dividends. And there's preferential tax treatment for Canadian residents that qualify for a dividend tax credit. So that's kind of the basic, strong equity Canadian companies, something that we see very often. There is interest and other income, and generally fixed income ETFs earn interest on those investments in bonds and other debt obligations. And so when an ETF pays out a distribution as interest and other income, the distributions are treated as ordinary income. So that's the same marginal tax rate as employment income. Another one that also comes up and that we see a lot of are capital gains. So an ETF may incur a capital gain if an underlying security of an ETF portfolio is sold for more than its purchase price. And only 50% of capital gains are subject to tax in Canada and must be included in the investor's taxable income. And then another one we often see too is foreign income and foreign taxes paid. So when an ETF earns dividends or interest on foreign investments, the ETF may have to pay foreign withholding taxes. So when the ETF distributes the foreign income, a Canadian investor may be able to claim a foreign tax credit with respect to the foreign taxes paid by the ETF. Now, generally speaking, like ETF capital gains, those are paid out annually as reinvested distribution. And in that case, there's no cash payment, but we do often see monthly, quarterly, and annual distributions come out from a cash perspective. So just be on the lookout for that. Many of our ETFs pay out a monthly distribution, quarterly, and then of course we have our annual reinvested distributions as well. And then just speaking to the slide here, Erin, we have a note about looking at the differences between a hedged and unhedged ETF and what the differences may be from a tax perspective. So similar to a return stream, whether you're making the decision to go hedged or unhedged, that will have an impact on your tax perspective because there could be gains on the currency, and currency, as we know, given the last little bit, can have a very big impact on your return. And then in terms of the adjustments that you should consider, we'll kind of dive into that further, but the one thing to note is all of this happens at the dealer level for investors. So you're not going in manually and readjusting anything on your end.
Yeah, the currency is a good point, because I think that's a question we get a lot when people see a bigger tax bill than normal, when they can't figure out if the market hasn't moved that much. Currencies do move quite a bit in some years, so that can have a big impact as well. I think we missed one, which is ROC, return of capital, and we definitely get a lot of questions on this. There's a difference between good ROC and bad ROC. So can you explain sort of why some investors may get a portion of good return of capital, and what's the difference between that and bad ROC?
Sure. So any distribution that's paid out in excess of taxable income is classified as ROC. So that's your return of capital. For cash income distributions paid throughout the year, BMO ETFs generally distribute based on the underlying portfolio yield less the expenses. Now, this is really beneficial for investors by providing greater certainty on the payout. So as the ETF grows, the income earned is allocated across unit holders. And then the important consideration for ROC is whether it impacts the sustainability of the distribution. And that's where we really define good ROC as sustainable, where the invested capital is not depleted over time, and whereas bad ROC is kind of dipping into the invested capital to support that distribution, which then leaves less investment for future years. So when you're looking at these products, these are just things that you want to be aware of. You know, all ETF providers post their tax breakdowns on their website. So when you're looking at which products to invest, these are all things that you want to look at and be aware of, that, you know, definitely want to gear more towards good ROC that's sustainable over time. So it's really important to look under the hood and really understand what you're investing in and how the company handles the tax treatment of their ETFs.
And good ROC, of course, could come from like an ETF that's just growing really fast. It could come, you know, some ETF providers try to keep that distribution a little bit more consistent month over month, and that can cause good ROC. They're still at the end of the year earning that yield, but you know, month to month, there may be some portion of ROC because they're trying to keep that consistent month to month. So definitely good considerations there around ROC. Now, phantom distributions, I feel like this is just a mystery to so many people. So let's get into phantom distributions and what causes them, and how, as an investor, do you typically deal with them?
Great, and I think that's a great image there of phantom distributions, but they're not meant to be scary. From an investor standpoint, a lot of this is handled at the respective dealer level, so nothing to be fearful from. Just looking at the imagery there. So what are phantom distributions? So as I mentioned before, an ETF can incur a capital gain if the underlying security in the ETF is sold for more than what it's purchased at. And like I mentioned before, ETF capital gains are generally paid out on an annual basis as reinvested distributions. So in that case, there's no cash payment, and instead it's automatically reinvested into the ETF, which results in an adjustment of the unit price, but does not change the number of units held. So as a result of that, an investor's adjusted cost basis, which we generally refer to the ACB, which is the average cost of the purchase of the securities, is increased by the amount of the reinvested distribution. So the reinvested distribution adds back to the investor's total adjusted cost base, resulting in a lower capital gain once the ETF is sold, which helps to ensure there's no double taxation. And then what really causes phantom distributions are what we kind of mentioned before when we were looking at capital gains. So some of these gains can be, you know, it could be incurred from things such as a corporate action. So a merger acquisition occurred in the underlying holdings. The ETF may then realize a capital gain, or kind of the day-to-day operational aspects of running an ETF, so things like portfolio rebalancing. So when this occurs, the ETF will trade the underlying securities, meaning the portfolio will turn over, which in theory will then create a capital gain. So those are just things to be kind of mindful of how it impacts you. But again, you know, this is done at the dealer level. And again, reiterating the point that Erin mentioned earlier, that, you know, if you want to kind of manage your phantom income, you have to understand too, like, is it a tax sheltered account? So if you're in a registered account versus non-registered, these are things that you either have to worry about or you don't have to worry about.
And from a timing perspective, usually these reinvested distributions get announced beginning of December, I believe. Am I right? And then
yeah, so we announce what the reinvested distributions are in December, and then come end February, mid-February, end of February, each respective provider will post the tax breakdown for the tax distributions. And then that will get filtered out at the dealer level, in which once they receive those, then investors can expect to see their adjusted cost basis on their statements.
Okay, perfect. Thank you for that. Now, I have spoken about T series or T units on previous episodes. So just as a reminder, these are a new innovation in the ETF space over the past year or so. BMO has brought this to market. We've taken basically a popular mutual fund strategy that offers investors a way to transition from the accumulation phase to the decumulation phase of investing. So we have two T series, ZBAL.T and ZGROW.T. And what they do is they pay a 6% annual distribution on a monthly basis. And what this really does is provide retirees that regular cash, or that regular tax efficient cash flow. And the reason I put this in is because I received a question around the level of ROC on these units, and we'll go through an example coming up in a couple slides. But just, I don't want to shy away from the fact that these distributions on these T series or these T units may contain some level of ROC, which is why we really sort of gear these towards that retiree community who are, as you know, looking to draw from their investments anyways as they enter retirement. So I will get into an example and more on that as we move forward here, but I wanted to go through a couple examples from our website just to show you how this looks, the look and feel if you were to go there to find this information. First one up here is ZSP, the S&P 500 index ETF. So you can see here it pays quarterly distributions. Last year, the first 3 quarters, it paid 20 cents. The last quarter, it paid 22 cents for a total of 82 cents per unit over 2022. And then if you go to the next section down, which is the tax breakdown, as we would expect, the majority is from foreign income, being that it's a US equity ETF investing in US domiciled stocks. But you can also see that a portion of that tax is already paid or withheld. 13 cents, negative 13 cents there, that's already been withheld. And that's an important consideration too, you know, for Canadian listed ETFs like ZSP, this withholding tax may actually be treated as a credit on your T3. But you should definitely consult your tax advisor on that, but that could be a benefit for Canadian listed ETFs like ZSP. You'll also see here a small portion of ROC. This is what we would deem as good ROC, what we were discussing before. You know, it can result from a number of different things around the functioning of the ETF. Fast growing ETF, you know, ZSP is one of our more popular ETFs, so that's probably where it's coming from. But just wanted to point that out as a good example. And then I put up ZBAL.T here, which is an example of our T6 unit. So we discussed here, it's got that 6% annual distribution. You see the 15 cents a month, that makes up the 6% a year. And then if you go down and look at the tax breakdown, you'll see here is that there is a portion of ROC. So again, we're not shying away from this. This is a retirement solution where generally investors are beginning to draw from their investments anyways. So there's the tax breakdown for ZBAL.T for last year. Also, just a note, ZGROW.T hasn't been around for a year yet, so it doesn't have an example of this yet, but you'd likely see, I think it's safe to say, a lower percentage of ROC from ZGROW.T because it does have a higher weight in equities. It's got 80% versus the 60% in equities for ZBAL.T. So I think that would result in a lower portion of ROC on that one because it would be earning a higher yield. All right, Mackenzie, let's get into another couple considerations when it comes to taxes and ETFs. Some investors have to deal with US estate taxes. and the burden of filing the T1135. Can you give us an overview of who would have to worry about this and what investors should consider when evaluating their different options?
Sure. So investing in Canadian listed ETFs, investors can mitigate the amount of foreign taxes paid. So if you look at withholding taxes as an example, if you're a Canadian resident that holds a US listed ETF that then holds an international security, investors could be subject to paying 2 levels of withholding tax. So that can make a big difference and not be something that you're even aware of until you get your tax bill. But BMO ETFs avoids this unrecoverable tax by holding the underlying securities directly, allowing for foreign taxes to be claimed. So again, it's really important to look under the hood and really understand what the ETF is holding, because you could be shocked with some of these, reporting requirements or double taxation. And then with T1135, Canadian ETFs are exempt from this reporting requirement, even if they hold foreign securities. So that's beneficial for investors when they're looking at different ETFs to consider within a portfolio. So being Canadian listed versus US listed, there are some different requirements that do come into play. And then with US estate taxes, Canadian ETFs are generally not considered US assets. So again, something to consider when you're selecting your ETF. Really important to understand what you're investing in and understand the underlying holdings. Like for our ETFs, for example, we display our holdings on our website. So it's very transparent what we're holding. But these are very important things that can play into effect with taxes, especially reporting requirements for US tax filing purposes. And then as well, we do have PFIC statements available, which do help some investors with their US tax filing. So again, this is more of just an aid to help investors when they are filing their US taxes, but these are all things to more so be aware of when you are making your investment and just understanding the requirements that come with this. And again, depending if you're considered a Canadian resident or a US resident, there are different tax implications for that as well.
Okay, good to know. And then we've added a screenshot here of a T3. Can you walk us through this example in terms of what the different boxes are showing?
Sure. So good news is this comes from your dealer. You are not manually have to worry about this. This comes in the mail from you, again, from your respective dealer, sorry. I would suspect this comes in and around this time. Some may be earlier, some may be a little bit later, but I would look out from your respective dealer. And this is really an example of what you could expect. So I would just, again, some of the things that we talked about before. So your capital gains, your dividends, your return of capital, your foreign non-business income and income tax paid. These are all highlighted in the boxes here of where all this information is to be populated. I think really knowing where this comes from is things that, you see these numbers on your T3 and sometimes it's not even clear where they're coming from. So just all the key components that we report on our website and all the key elements that we spoke about earlier, they are reflected in your T3. So if you're trying to kind of understand that, this is a good aid just so you know which boxes represent which. And if you are looking for more information or you want to look at different things, we do report tax factors on our website, or you could also visit the CDS link, which also gives a breakdown of the tax factors as well.
All right, so we've talked a lot about our website as a resource for our ETF investors, but what other tools or resources do we offer to help investors?
So we have some great tax resources that investors can leverage. Everything is posted on the ETF Market Insights website. So I would encourage everyone to go there to find all this information. Again, there's lots on our individual product pages, which is on bmoetfs.com. So in there, on the respective product pages, you will find distribution history as well as tax history. But if you're looking to kind of understand more, give you kind of like an FAQ or what to expect during tax season, we have a great PDF document that's posted on the Market Insights website that really walks you through the different types of distributions, return of capital, capital gains, phantom distributions, what to expect, and as well as some of the other reporting requirements. So it's just a great guide for you to leverage during tax season. And then as well, we do have a PDF put out that goes through detail of all of the tax breakdowns for our distributions for our whole shelf of ETFs. So if you own multiple ETFs with BMO, then it's an all-in-one document where you can find everything for the respective ETFs. So I would encourage everyone to go check out the website. And if you have any questions, again, send them in and we're happy to answer them.
All right, thanks, Mackenzie, for that overview. And yes, that FAQ doc basically goes a little bit more into depth or covers a lot of what we talked about today. So if you need a summary, that's a great one. All right, let's turn to the audience questions. We only have one this week, and I actually received this a couple weeks ago and held off because I know we weren't able to cite the distribution yield. But what's the yield on the new two new covered call ETFs, covered call energy and covered call healthcare?
Yeah, so we launched these back in January. So we did pay out a cash monthly distribution. So these ETFs pay out monthly. So the covered call energy ETF, the distribution yield is around 8.8%. And our new healthcare covered call ETF, which is the ZWHC, has a distribution yield of 6.65 right now.
Perfect. And then if you want to know more about covered calls and where that yield is coming from, we talked about this a couple months ago, but we do have a great piece on our option strategies on etfmarketinsights.com under the enhanced income section, where you can see exactly where that yield is coming from. So what portion is coming from the underlying dividend paying securities and what portion is coming from the option overlay. And then even further into the weeds in terms of what that option overlay looks like, how far out of the money and how much of the portfolio is written and all that information. So I also wanted to re-highlight that as a resource that we've had a lot of really good feedback on in terms of our transparency around our covered call strategy. All right, so that caps off another great week of ETF Market Insights. Thanks, Mackenzie, for walking us through taxes when it comes to ETFs and things that investors should be considering. So hopefully you all found that useful. We will be off next week with March break here in Ontario and back the following week where we will be discussing emerging markets. I'll be joined by Vish from our PM desk. We'll look at performance of emerging markets, the outlook, and the opportunities. So I will see you then. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.